Investors, what if I told you the market just pulled off one of the most bullish patterns we've seen in decades, and almost no one saw it coming? Not the headlines, not the Federal Reserve, and certainly not the financial media. But we did, and in this video, we're gonna break it all down. Back in early April, while most were calling for more pain ahead, we anticipated a sharp reversal, not a recessionary-induced collapse, but a textbook V-bottom. And believe it or not, whether we were good or just lucky, that's what happened. Over 1,000 points up in 2 months, and the data now backs it up. This isn't speculation, it's history repeating itself. In fact, previous V-bottoms like this have often been followed by strong forward returns. According to data from the Carson's Group, Ryan Dietrich, in 16 out of 17 similar bear market recoveries, the market was higher 12 months later by an average of nearly 19%. And that's with a 94% win rate. And this one, it's unfolding without the intervention from the Federal Reserve. So what should you expect from here? Could we be looking at a grind higher through summer, a temporary pullback in fall, and then new all-time highs in 2026? Stay with us. We're going to walk you through the market signals, historical context, and what this means for long-term investors. Because if history is any guide, this rally could be far from over. For the next few weeks, starting about a week after April 7th bottom in stocks, our videos all highlighted the same opinion and thought. Our team messaged that we thought this would be the low for the market and stocks would subsequently move sharply higher. There was no lower low in the S&P 500, no retest of the April 7th bottom, and no new breakdown despite the loud warnings from several retired billionaire hedge fund managers at the time. Instead, the markets climbed steadily, climbing back above the 200-day moving average and returning to the levels where it first broke below the 50-day moving average in late February through early March. We hypothesized that the second leg of the move down to minus 20% was an event-induced bear market correction and not a recessionary economically induced sell-off that lasts for quarters and sometimes years. Investors, ex the great financial crisis in 2007-8 and the bursting of the speculative dot-com bubble frenzy in 2000 and 2001, which did precede much longer and deeper recessions. History suggests that enough damage had been done and we would form a V-bottom in a near exact similar fashion to the V-bottoms of the last 20 to 30 years. And so it now appears after nearly 1,000 points gained in 2 months, others are finally seeing what we did, a V-bottom in stocks. Let's call it the victory formation and take a knee given our comeback prediction being met. Okay, investors, looking backwards in the rearview mirror, the explanations were initial dovish tariff talk, the better than expected first quarter earnings reports in April, and the May 9th China tariff deal, and then stable to better economic data all throughout April and March. There were only rumors of lighter tariffs coming before the April 24th Zweig breath thrust, creating the first of what many chartists call a bullish island reversal pattern. And investors, the good news here, this V-bottom looks to have happened without the Federal Reserve intervention and interest rate cutting. So after regaining 6,000 almost to the day, the market would be expected to, in a V-bottom, Friday, June 6th. What should we expect in the S&P 500 from here? In our May 31st video titled Stock Markets V-Bottoms, we laid out what investors might expect throughout the summer months. Here's a brief recap. It would be a lurching grind higher to 6,200 plus, then taking the better part of 2 to 3 months. That would be normal, before dropping back to near flat year to date. I'll drop a link to the video in the description below if you haven't seen it. And let me take a moment to ask you to subscribe to our channel if you aren't subscribed, and hit the notification bell so you'll be notified when I upload new content. And if you know someone who might benefit from this information, please take a second to share this video with them. Beyond summer, looking into fall, what might investors expect from the markets in late 2005 and 2026? For all the good times in the past, should you go to cash now given the markets regained most of their losses and sits about 2 to 3% below their all-time highs near 6150? History says no. You should stay the course and actually hope for the normal late summer, early fall sell-off to add to positions, as more major gains could lie ahead over the next 15 to 18 months. We've discussed the presidential cycle many times here at Oak Harvest over the last 7 years. We'll get into the details of that again later in the year, but suffice it to say, we are inching closer to what is historically the best stock returns under a president. That is, the fourth quarter first year and second full year of their term. Why? Probably because they focus on economic growth to help create a tailwind for their party into the midterm election late in year 2. We'll cover that data later in the year, so make sure you subscribe to our channel. Okay, back to data from Chief Market Strategist and fellow data junkie Ryan Dietrich at the Carson Group, showing historically strong forward returns are possible from here, despite the positive 20% move we've had off the recent lows. In fact, historically, moves like this, fast and furious, higher off the lows, bodes well for returns over the next year. According to Dietrich, looking at the previous 17 bear market corrections, or near minus 20% ones, after stocks then regained positive 20%, stocks were up a year later 16 out of 17 times for a 940 batting average. The one and only time the stocks were lower was during the sell-off during the COVID pandemic. Investors, this data isn't bearish. This data says V-bottoms are bullish for future returns over the next year. Hence, I'm calling this episode the Victory Formation. Here's the data, let it sink in. An average return of near 19% and a median forward return near 18%, with a 94% hit rate. There are only 4 12-month return periods in this table that are lower than 13%. 1965, my birthday year, 1978, 87, and 2019. If we take the average of the median of these years from Ryan's data table, we'll get about the same triangulation for the summer of 2026, around 7,000 on the S&P 500, with no promises or guarantees, of course. Similar V-bottom data from my friends at Franklin Templeton, Lucas Kolwick, and Chris Gallipo. 40-day S&P 500 turns was 19% mid the first week of June, right before 6,000. Since 1935, there have only been 13 such periods. A year after the one-year average forward return, 20%. No guarantees for all you compliance managers out there, but you can say wall of worry. You can rationalize why markets have V-bottomed since early April on walking back of tariff extremism, better jobs, and wage inflation data, but viewers who know me know I like real-time market data. The bond market data since early April was saying real growth was okay and inflation peaked in early April, not the stagflationary doom bias calls many have suggested. Investors, even from here, after this rally, history's on the side of the bulls, not the bears, over the next 12 to 18 months. The strategists who called for a retest have now been wrong for at least 1,000 S&P points. Okay, so from here, 6,000 when this was penned, there's not a really change in my outlook. Let's call it what it would be. A lurch and grind higher, about 1 to 1.5% per month, or about 100 points per month into an August summer top, which is a very normal seasonal time for the markets to peak. After that, we would expect a normal summer pullback into the markets. Many institutions got too bearish near the April lows and de-risked and are way behind their performance curve in the second quarter. If this plays out as normal, then they will be even farther behind the indexes and the benchmarks by August. So any summer sell-off, say into early October, would likely be a buying opportunity for a year-end rally and more new all-time highs next year in 2026, like the V-bottom and the presidential cycle histories suggest. This is why our team has stuck with our 2025 year-end target of around 6,600, even as stocks sold off into April, and most strategists slashed their targets from over this number to the low 5,000s and are now raising them back higher once again. Okay, with this positive outlook, does this mean you shouldn't add to stocks, particularly if you're younger and in saving and accumulation mode? No. Rarely can you pick the absolute level in both price and time on both the buy side, the sell side, and the buy side once again, particularly in growth stocks. Regardless of the path for the economy and the financial markets over the next few months and throughout the rest of the summer, the investment team at Oak Harvest Group will be here, crewing the ship and adjusting our models where we can. Investors, until next week, I'm taking a knee in the Victory Formation. So have a blessed weekend and know that the Oak Harvest Financial Group team is doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement. And if you're not a client yet, give us a call. We'd love the opportunity to help you navigate these times.